Hello everyone, and welcome to this week's Motor Trade Radio podcast. Powered by Motors, the driving force behind multi-site advertising. With Philip Nothard and Curtis Hutchinson, bringing you all the chatter that matters.
Well, this week, Phil, we're pretty much guests on our own podcast, aren't we? Because we've got conversations with three industry people.
We have, yeah. This is testing our technical capabilities on the system today, isn't it, Curtis? But yeah,
we are stretched to max, aren't we?
We are, but it's good. I mean, we must give a shout out to those that have sent in the press releases, and we always do say if you have got a story that you want us to cover, that you believe is something that we should be talking about on the podcast, then please do feel free to send it us on email or reach out through one of our social channels, and we'll certainly try and let's stitch it into the headlines where we can, don't we?
Yeah, definitely. So, as you've probably guessed, we've got a packed show this week. So we'll start in a moment with an extract from our interview with CAP HBI's Senior Valuations Editor, Jeremy Yea. Jeremy was talking about May's trade value movements. The full interview went out on Thursday and is on your podcast feed. But do listen out for the extract that we've got, because it really does give a bit of context behind the figures.
Exactly. And we've also this month's top tip from our resident industry guru, Ian Godbold. And this month, Ian talks about the importance of call tracking for measuring marketing performance and call handling. So please do stay tuned for the halfway break for that one. And it's not one to be missed if you are obviously in the retailer space.
Then the second half of this week's show is devoted to our special interview with Vertu Motors CEO, Robert Forrester. Now, our wide-ranging interview with Robert covers the group's recent full-year financials, which went up to the end of February. Robert also shared his views on current and future trading, the new and used car markets, the CEF mandate, and the possible easing of the expensive car supplement, which was applied to EVs in April, and lots more besides. So do stay tuned for that in the second half of today's pod.
A little bit of opinion on the politics as well, which
he does touch on politics.
But as Curtis said earlier, first we're going to play you a brief extract, and this is just the opening question to Jeremy on the movement of the values in May as we head into June. But as Curtis said there, do head over to your podcast feed for Thursday morning, where you'll find the full interview there from Jeremy, who gives you a little bit more detail behind that headline figure and shares his view on where he expects the market to head as we move into the second half of the second quarter. We'll get on at the end around your prediction from last month into this month and what you expect going forward. But to begin with, let's go through the usual, looking at the headline figure. That 3-year 60 point was down minus 1.3%. And, how did that market in May compare to previous Mays as we move into the month of June there?
Yeah, so as you just said, down 1.3%. That's actually, on the stronger side. I think it's our fourth strongest May into June on record since Cap Live was introduced in 2012. So a really steady month overall. A drop of about 3-year 60, about £235, or roughly around £235. So yeah, it was a pretty good month. I thought it might go a little bit more, if I'm being honest. I thought it might be at least 1.5. As we got quite early into the month of May, and the disruption that you mentioned earlier about the bank holidays and what have you. And it was a bit disruptive, and it always is, especially being so close to the Easter bank holiday that we had previously. So how that compares to previous May into June's, pretty good actually. It's actually in the last 4 years, it's the strongest movement down. Last year it went down 0.9%, and the year before went down 1.2%. And 2022 went down 0.7%. So it does look a bit worse than the previous 4 years. But bearing in mind, if you remember some of the I guess the disruption we had at the back of 2023 and these really strong movements, hard moves we had down. I think that's why last year was actually quite strong compared to usual seasonal averages. Seasonal average from May to June 1.6%. We ended at 1.3. I thought it might be 1.5. So yeah, I think it ended up pretty good. I think from more stability around for all, which I think is hopefully quite welcome by everyone in the industry.
And I mean, obviously, we'll get on to sort of fuel types and sectors shortly, but that sounds more like, and we hate to say it, more like a normal sort of seasonal movement for this time of the year, going from sort of May into June.
Definitely, yeah. I think you've got to look to the pre-COVID movements month by month, or the average from 2018 to 2013. It fits perfectly within that. If anything, it's the stronger side of even the pre-COVID, but definitely seasonal is. We've gone from using the S word of stable to the S word of seasonal now, and it definitely feels like that. No matter who you speak to, retail or trade, it definitely feels that.
You're listening to the Motor Trade Radio podcast, powered by Motors.
Headlines this week come from Motor Trader and the Daily Telegraph, plus we've got press releases from Waylands and Sandicliffe, starting with dealers cut used car prices in May to shift stock, electric cars halve in value after just 2 years, Waylands delivers record 2024 results and announces expansion of its Polestar network, and Sandicliffe named one of the best big companies to work for by the Times.
Yeah, so as Curtis said there, we're heading over to Motor Trader to begin with, and this is that dealers cut used car prices in May to shift stock. Now, this is content from the latest market view there from Motors, who, looking at the high used car stock volumes, has prompted competitive pricing in the month of May. And this is, as I say, reported there from Motors, saying that dealer inventories reach a new high for the year following 3 months of growth, and that prices dipped 1.8%, or the equivalent of £323 month on month, which was led by the franchise dealers that were down 0.6%, the equivalent of £138, and that used EV prices averaging less than hybrids for the third month in a row. So I know this is content and data that you looked at with this one, didn't you, Curtis?
Yeah, I did work with the Motors team on this for their latest market view, so did see the data and some notable trends across the month of May. And you've mentioned about stock levels. So dealer inventories for the month averaged 52 units, and that's actually the third successive month of growth, with month-on-month increases across supermarkets, franchise dealers, and independents. So all three dealer sectors that Motors monitors for its market view. So looking at prices, the average price of a used car on Motors was £17,197. And as you said, that's down 1.8% month on month. The drop was led by franchise dealers, down 0.6%. So consequently, franchise sites enjoyed the biggest increase in sales. So prices dipped down a little, sales went up, and sales actually went up by 11% month on month. But that was also experienced across the other sectors. So sales in independents were up 6%, and car supermarkets were up 4%. And if we look at some of the price droppers, the two biggest price droppers for the month were actually both Tesla Model 3 vehicles. So the 3 to 4 year old examples were down 3.3% to 19,452, and older 4 to 5 year olds were down 3.2% to 17,833.
Yeah, and let's say the report is readily available to look at. So a lot more of this detail. The report on obviously overall days to sell. We're up marginally from 29 days on average to 30 days, with car supermarkets achieving the fastest selling sales to days to sell at 21 days, followed by franchise dealers at 23 days, but independents up there at 47 days. and also reported that younger profile cars dominated the fastest sellers, with Vauxhall Corsas aged between 6 and 12 months, averaging just 9 days in stock, followed by the Ford Explorer under 6 months, followed at 12 days, and the MG HS models less than 2 years old at just 12 days there. So as I say, there's lots of data in that report. And just to finish off here, following 2 successive months of price rises, it was just a matter of time before we started to see some downward pressure, especially as dealer inventories have been growing since March. And that's a statement there to finish off with from Lucy Tugby, the marketing director there at Motors.
And next headline is from the Daily Telegraph, and it's electric cars halve in value after just 2 years. So this is an exclusive that the Telegraph ran on Thursday. And I must share this with the listeners, Phil, because it's based on data that you supplied from Cox Automotive. And when we interviewed Robert Forrester, we interviewed him quite early in the morning on Thursday, and he'd already read this piece. He was already quoting it back, wasn't he?
He was, yeah. I mean, he's certainly all over this stuff, yeah.
Yeah, pretty impressive. So this particular story, written by Matt Oliver at the Telegraph, it says that EVs are losing more than half their value in the first 2 years of ownership, amid a wave of heavy discounting by car makers, which we do talk about from time to time on the podcast. But your figures show that a typical EV now retains only 49% of its value after 2 years. And that's a big decline from 83%, which was being reported by Cox Automotive as recently as 2022.
Yeah, I mean, this is looking at sales value of used battery electric vehicles through the Mannheim auction, and looking at them as a sale trade value sold as a percentage of that vehicle's original cost new. And when you start to compare the two, back in 2022, their average under 2-year-old EVs were fetching 78% of their original cost new, compared to petrol vehicles that were achieving 84%. But year to date so far this year, again, looking at those pure battery electric vehicles under 24 months old, are achieving on average 49% of their original cost new, whilst the equivalent petrol vehicles are achieving 70% of their original cost new. So really highlighting the continued volatility of battery electric vehicles, particularly hitting that residual value market. And we kind of allude to that a little bit with Robert in the interview we had with him, didn't we? It was kind of landed at the perfect time. And we know now Robert reads the Telegraph on a daily basis.
And one of the interesting points within the story is the falling values of EVs is also being accelerated by the growing range of cheaper models available on the market. And we've certainly seen this over the last year, maybe 2 years, with some of the new brands coming in with cheaper models. In fact, some of the legacy brands as well. I know there's some fairly reasonably priced EVs from the likes of Vauxhall, but that's starting to bring down the prices as well.
It is, yeah, and we talk about that with the Insight Quarterly report, who was launched again this week from ourselves and myself here, that which goes into a lot more detail of what we've just covered there. But again, it talks about that life cycle, and we talked about it with Jeremy on the full interview there with Jeremy Yea, that the EV sector is still volatile because of the new entrants, because of evolution of technology and enhancements of range technology, etc. So the EV market, as Robert said on his interview, is still opportunities there, but you do have to be very careful and know what you're looking for in that marketplace.
And the next headline is actually from our first press release this week, and our thanks to John O'Hanlon, who sent it in personally to us. So many thanks to you, John. The headline on the release is Waylands delivers record 2024 results. So this is the full year from Waylands, which showed a 24.2% increase in profit performance for the year, and that was up to 3.1 million from 2.5 million. And the strong performance across the board saw the group deliver record new and used sales volumes, which were up 13.4% to 8,665 units, alongside a 20.5% growth in after-sales revenues to 23.5 million. So a particularly strong and record year there from Waylands, but I think they all have been. Every year they report increases on the previous year.
He's doing a fantastic job. I mean, you can see why he's always such a happy gentleman, and we are going to get him on the podcast in the coming months. So do keep tuned for that one. But again, fantastic business and what an operation, John runs there. And there's a comment in the press release saying that they're delighted to report another year of growth against a backdrop of challenging trading conditions. And the fact that they've continued to perform well is a testament to the strength of their brand partnerships, the hard work of the team, and the continued success of their strategy. And he also added that they remain on track to achieve their strategic goal of 16,000 unit sales.
And it was a particularly busy week for Wayland because they also announced that they've taken over representation for Polestar at Bicester, and that's from the beginning of June. And this is a good move for the group because it expands their representation with Polestar, and the site itself was actually launched and managed by Polestar UK. It was launched in December 22, and within the piece, Matt Galvin, MD of Polestar, says, "We have had huge success with our Bicester space at our UK headquarters. It has become a destination for Oxfordshire and the surrounding counties for customers looking for fun-to-drive performance EVs with amazing tech and transparency in terms of environmental impact. As we look to expand our business across the country, I'm delighted that Waylands will be running the Bicester space to build on this success." So, it couldn't actually go to a better retailer in that Oxfordshire area.
Oh, exactly, and very much the reasons to be proud from there with John. And the last story before we go to the break and then the second half of today's podcast is again shared to us. This was shared to us by Ian Godbold, our industry expert, who you'll hear from shortly through his top tips. But this is that Sandicliffe named one of the UK's best big companies to work for by the Times, and that's now for 2 years running. And that Sandicliffe, one of the East Midlands' leading family-run car dealership groups, has once again been recognised as one of the best big companies to work for in the UK by the Times, making it the second consecutive year on this prestigious list there. So, I mean, a big shout out for the team there at Sandicliffe.
Yeah, definitely. And Sandicliffe were actually just one of 2 car retailers in the listing. The listing is of 115 best big organisations, and that's based on companies employing 250 to 1,999 employees. And it's worth looking at the Times listings because they're actually ranked alphabetically, rather than sort of 1 to 115. But Sandicliffe is ranked there alongside the likes of the Savoy Hotel, Checkatrade, Champneys, and Rightmove. So, a fascinating cross section of different sectors. And Sandicliffe, as you say, it's their second year in the listings, and they'll be very, very pleased with that.
Yeah, exactly.
Rightly
so. So congratulations to the team there. But next up, we've got the top tips from our industry consultant and friend of the podcast, Ian Godbold. This month, Ian looks at the importance of call tracking for measuring marketing performance and call handling.
You're listening to all the chatter that matters on Motor Trade Radio, powered by Motors, the driving force behind multi-site advertising. This is your weekly one-stop shop for all the biggest car retailing headlines from across the media. Available on demand, wherever you are, on your podcast feed. Next up is car retailing industry guru Ian Godbold, sharing his top tips on how to steer your business to success.
Hi everyone, and welcome back to this month's top tip. Today I want to talk to you about something that's making a big impact for a lot of the independent dealers and smaller groups I work with, and that's call tracking. Over my 20 plus years in the industry, I've seen lots of systems promise to improve lead handling, but this is one area where technology has really caught up with the needs of smaller operators. What used to be available only to the big franchise groups, featuring call recordings, IVR menus, smart call routing and automated SMS follow-ups, is now accessible to the independent dealer and smaller dealer groups without the complexity or high cost. What I found really valuable is how call tracking gives you total visibility into where your leads are coming from, whether it's from Google Ads, SEO, marketplaces, social media, your own website, or even offline sources like newspaper ads or flyers. You can finally see what's actually driving calls, not just clicks. That's been a game changer for some of the smaller groups I work with, who's discovered they were investing in marketing channels that weren't delivering and reallocated that spend for better results. But it's not just about knowing where calls come from, it's all about understanding what happens on those calls. Many systems now include AI-powered conversational analytics. That means that you can look at trends in what customers are calling about, how those calls are handled, and even the tone and sentiment behind them. Are certain queries being missed? Are people sounding frustrated at particular stages? These are insights you just don't get from a lead form or a basic call log. One dealer I support used the insight to identify a training need around finance inquiries. They worked with their team using real examples from recent calls, and within weeks saw a notable increase in finance lead conversions. It's a great example of how insight can lead directly to action and results. Another feature that's proving useful is interactive voice response, or IVR. Even if you're a single site operation or using mobiles, you can still offer a professional sounding call menu. Press 1 for sales, 2 for service, and so on. It helps route calls efficiently and gives customer a smoother experience right from the first ring. And when calls go unanswered, which we all know happens, especially during busy periods, automated SMS follow-ups and instant email alerts mean you don't lose a lead entirely. It shows customers you care and gives your team a second chance to engage. There's no big tech knowledge required, and setup is often done in hours. From what I've seen, the biggest benefit isn't just visibility. It's how quickly dealers can use that insight to improve call handling, adjust their marketing, and convert more inquiries. So my top tip this month: if you're not already tracking your calls, now's the time. It's one of the most effective, low-effort ways to boost your dealership's performance and get a clearer picture of what's really driving your sales. Thanks for listening, and I'll catch up with you next time with a more real-world advice to help you stay competitive.
Well, it does cram a lot into those little snippets there for advice for the retailers of areas that, you know, with everything going on a day-to-day basis, trying to manage sales, acquire stock, and everything else going on, you know, these little things might just be missed where they can pick up these little opportunities to improve their operations. So it's always a fantastic little quick listen there from Ian, isn't it?
Yeah, definitely. And he does make a valid point about this call handling tech that was once the domain really of the big franchise dealer groups, but it is now available to all dealers. And it doesn't cost the earth, so definitely worth looking at. So many thanks to Ian for that. If you want to get in touch with him, you can direct message him on LinkedIn, or you can contact him through motortraderadio@yahoo.com if you drop us an email. We look forward to hearing more from Ian next month.
Yeah, and we'll be back after the break with our exclusive interview here with Robert Forrester, CEO of Vertu Motors.
You're listening to the Motor Trade Radio podcast, powered by Motors.
Well, welcome back to the podcast, Robert. It's really good to have you back on.
No, it's great to be invited.
Yeah, we've got lots to talk about. So what we'll do is we'll start with your financials, because a fortnight ago, Vertu published its results for the full year ended 28th of February. So we actually thought this would be a good opportunity to catch up with you and hear your take on what shaped the year and your thoughts on current and future trading.
So, welcome, Robert. I think obviously we did talk about your results a couple of weeks back when they were first announced, but the results showed revenues were up whilst profits were down, which has been a kind of familiar theme when you're comparing 2024 to 23 there. And we obviously talked about that on the podcast, but what's your analysis on, what drove that? And as a bit of a follow-up, how much of an impact did some of the brands get switching to agency have on your profitability?
Well, dealing with agency first, I don't think it had any impact whatsoever, to be honest with you. You could argue in a push market that agency is beneficial. A genuine agency, you have no stocking charges, you have no discounting, so your new car profitability is robust as long as the manufacturer can deliver the volume. So I don't think agency was a major feature, and actually our presentation to investors didn't really discuss agency once.
Right.
So I don't think that's in any way where we were. I think last year, and remember our year ends to the end of February, so it's broadly 2024, a bit of 25. We knew we were going to have cost pressure. That was obvious. The budget last year, year before last, had increased the national minimum wage quite substantially. There were going to be major knock-on effects of differentials because this minimum wage had been creeping up quite a lot. I don't think we'd moved the differential. So we had a big cost, about £10 million a year increase in core cost base. Bulk of that was payroll, but there were also big increases in demonstrator costs, more EVs depreciating at a rapid rate, impacting demo costs. And we did take some cost actions to try and reduce marketing, which we did quite considerably, but still there was a £10 million increase in cost, which I think we broadly knew about. We knew after sales was going to be good, and it was. It was up 12 million quid in gross profit in the core. We knew used cars would recover from the very poor year the year before when residuals collapsed. Fleet is a big generator for us. Okay, let's assume that's level. The real issue was new retail. And new retail, we thought we'd see some growth. You normally get a little bit of growth, don't you? But actually we saw an £11 million reduction in gross profit in the new car channel. So the entire decline in profits, which was about from 34 to 29, I think it was, came from the new car channel. And all the issues around that were as a result of the government's, plural, and the ZEV mandate. Yeah. Because the market was in a very poor state. The manufacturers were discounting 4.5 billion quid to get electric vehicles in. The private market ended up with a 10.7% mix of battery electric vehicles in that period. The targets were 22%, were way ahead of where most manufacturers were actually tracking, despite the discounting. And then we ended up literally rationing petrol and diesel cars. So you put all that together, we had lower volume, lower margin, and much reduced profit in new cars, which I didn't fully anticipate when we started off the year.
So that is really
where that year was. Let's be honest, it was the lowest retail market in new cars for 25 years. I mean, we should be sending the government a gold medal because who thought they could have actually done that? We sold less cars than during COVID.
It's an achievement.
It's a major achievement, but actually you half wonder whether they want it. Actually, they don't. I don't think the civil service, and I think the misnamed Department of Transport, I'm not sure even like cars. In fact, I'm pretty sure they don't.
Do you get the feeling, just slightly honest, you saw that all last year. Do you get the feeling it's the same again this year, or do you think that pressure from the OEMs has eased this year a little bit?
Very good question. And the truth is, I don't know. They obviously moderated the ZEV mandate in April. Knee-jerk reaction, in my opinion, to the Trump tariffs. It was done over that weekend, wasn't it?
Yeah.
In fact, I got given a press release at 3:00 on the Sunday afternoon that bore very little relationship to the actual announcement at 10:30. And I get mixed signals from manufacturers. I think on balance, the increased flexibilities, and I have to say I'm not an expert on that because understanding all that, I think is very difficult, must make life for manufacturers and therefore retailers easier.
Yeah.
But I don't think it's game changing.
Yeah, it feels there might be a little bit, because obviously the OEMs seem to be releasing a little bit more ICE product into the market.
Yeah.
Probably as an opportunity to try and recover some of the revenues, the loss of profits.
Yeah, and that's where they make their money. So why shouldn't they? So I think, I mean, let's be brutally honest. If you think we're going to get to 28% BEV mix this year, you are utterly delusional and know nothing about the car market.
I don't think anybody's forecast it, have they? I think even the SMMT are at 23.5%, I think, at the minute.
That is the government target still. Yeah. And next year's 33. So how are they going to explain all this to the public? I don't know. I don't know is the answer. I think we have to wait and see. And it'll all come in the second half like it did last year. But we literally last year, in the last quarter, had manufacturers who had no money, no appetite, and no plan. And the retail network clearly suffered because there was no volume. They'd already spent the budgets. They'd tried to push electric. They just gave up and reconvened in 2025, which is clearly not good news for retailers. Will we see that again? Well, let's be slightly optimistic and say that the moderation will take the worst effects of it off.
And Robert, just going back to your results, despite the challenges that you've outlined, you did actually see growth in retail EV sales, which were ahead of the market. And you also, as you've already alluded to, you saw strong performance in used car sales and after sales. Can you take us through the progress that you made across those three areas and what actually drove that?
Yeah, if we take retail BEV first, we put a lot of effort into retail BEV from about this time last year. A lot of training, a lot of conferences, a lot of focus, mystery shops. The market to the end of February, 12 months to February, private EV sales grew 12.9%, and Vertu, like for like, grew BEV sales 83%. So a massive outperformance in BEV, which let's hope will continue. And Hereford Volkswagen, number one in the network, in Volkswagen network, Mini York, number one. So we had a good time. Didn't save us from a profits warning, but still could have been worse.
Yeah.
In terms of used cars, it was always going to go up, wasn't it? Because we were not going to have a collapse in values and profitability that we saw in quarter four 2023. I think there are some positives and negatives about used cars at the moment. I'm exceedingly negative, and in fact, Mr. Nottard was in the Telegraph this morning on the subject about battery electric vehicle battery electric vehicle residuals.
Yes.
Which for a variety of reasons are going to be problematic, because the pace of technological change in, in battery electric vehicles is staggering. A car today is not what it was 3 years ago. Range, tech, design. So trying to get those 3-year cars into the used car market against discounted, low-rate finance battery electric vehicles, I think it's going to be a devil's own job. And the people who've got them sat on their balance sheets, manufacturer finance companies, contract hire and leasing companies, subscription businesses, if there are any left, and Motability, are clearly going to have some major challenges.
I think that's the thing now, isn't it? It's the particularly if you look at that 0 to 24-month-old market, where you've got, as you say, those asset holders, be it demonstrators, courtesy cars, lease fleet, rental, etc. They are fighting now against those still very aggressive new car.
They are, and let's be honest with you, and this I think could have an interesting impact on the used car market. We're now seeing 21 grand, 20 grand, 22 grand good electric vehicles coming into the new car market. So I think that is a very interesting and positive thing for battery electric vehicles, but could impact used vehicles. There's clearly a structural shortage of used cars in the 3 to 5 year bracket. That is bread and butter for franchise retailers. It's quite clear franchise retailers are losing market share compared to independents, because independents tend to be 5 years older cars. And I think that's putting pressure on used car volumes. I think used car volumes are under pressure for a number of reasons. I think manufacturers this year are putting more effort into retail new car sales, better deals, better finance. And I think that's impacting used. And we're just not getting the supply through. But so I think people are more going for margin rather than volume.
It is fundamentally wrong when you look at a mocker equivalent. So you look at the EV versus its petrol equivalent, that it's over £5,000 cheaper in trade value than its petrol equivalent. Highlights the fundamental issue in the used market for EVs, doesn't it? Essentially.
Yeah, but if a retailer buys them right, then it will sell them right, won't it? Yeah. So I think there's an opportunity in used EVs. Clearly there is. You just don't want to be, and demonstrate as being the issue, of course, you don't want to be holding them for too long.
You don't want to be hanging on to them, because the market shifts very quickly at the minute. That's the bit.
In an absolute disaster. But the general used car market, I think values will be strongish, actually. It's just getting the stock and actually driving the volume.
And I mean, back to sort of your financials and thinking ahead, and obviously, you mentioned in the 2024 results the impacts, and we spoke about it a couple of times, of that rise in cost pressures from minimum wage, which is continued to, it's one of those impacts on a business that it's just a cost. It's just a pure cost coming into your operation that you have no control over. But in terms of, recalibration of your business to, offset these cost pressures, and, we've got to talk about the autumn budget, especially on the, the national insurance employer contributions that obviously came into effect in April. How much additional cost did that the budget add to your business, and how are you mitigating it?
It added £10 million to our underlying costs, and we looked at all costs between October and February, and we made savings in excess of that because we were not going to absorb that £10 million. Yeah. We'd absorbed £10 million a year before. We were not going to do it again. So we had a root and branch from senior to dealership level review of headcount, probably for the first time in a lot of years. Reduced the headcount by about 3.8%, which is not a massive number, just under 300 people. Some of that actually related to dealership closures. So we closed Dorchester BMW, which was an authorised repair and used cars outlet, and the same in Barnstable. So that contributed to the 200 odd. Not something I ever relished doing necessarily, but just had no choice. And I think every British business has done exactly the same because it can't afford to carry on that way, which is why unemployment's gone up, of course. So we made cost savings offsetting that. The pressures on British business are going to continue forevermore. So we have a very defined digitalisation AI strategy with regards to pushing more and more efficiency into the business, making everybody a lot more efficient. So that we can increase productivity and potentially reduce costs, and I think we're well on our way with that.
And just as a follow-up to that, Robert, the sort of savings that you made over the course of the year, are some of those savings, are you able to carry those sort of processes into this year to also make savings?
Oh no, sorry, So there's a one-off headcount reduction, but that's not a knee-jerk reaction. That's a structural change. I mean, you know very well that we closed our sales outlets on a Sunday. Yeah. That allowed us to look at resource levels. But then we got a lot of work in the finance back office, making the finance function more efficient. Yeah. We've obviously gone to one brand now. Everything's branded Vertu. That simplifies the world of marketing and IT. One website, one set of development. The marketing money becomes more efficiently used, over 200 dealerships. So there's lots more to come.
Yeah.
We did do one thing actually using AI, which I thought was clever, which is Well, we got an algorithm which values used cars, and we change prices on 70% of our stock every day, up and down on used cars. But we were still discounting 83% of used cars to the customer. So we put in AI-generated alerts. So if a car has a discount in excess of 500 quid, it goes to the operations director. Immediately, the deal is concluded with details of the deal. And if the discount is above £1,000, it actually comes to me.
Yeah.
And then we have an inquest. And we've reduced the discounting from 83% to 50%, which is quite, in the number of used cars we do, is quite a material impact, actually, in terms of margin. And we also discovered with these alerts quite quickly that we had the most generous colleague purchase scheme on the planet. And some of our more intelligent members of the community were going and working out what the policy was, working out
how many cars could they buy per year through the.
We were giving discounts of $4,500 on some cars, which is good money if you can make it, isn't it? So we clamped down on that and put a limit of 2,000 in. So we've done a lot of work, and I think that's a very good example of where AI can actually generate value.
Yes.
In terms of providing better information.
Maybe Curtis, Robert's the one to ask about your experience of QR code to get a price on a used
Robert,
car.
It's a bit of a diversion, this, but a week or so ago, I took my car in to get it serviced, and I always wander around the dealelership, look at the forecourt. It's not one of yours.
He's one of them tie kickers, Robert, by the way.
An absolute time waster. Always look at the used car forecourt. And this particular used car forecourt, so it was a franchise dealer. It didn't have any prices on its used cars. It just had QR codes. So every car you went up to, you had to scan it to get the information on the car, engine size or whatever, and also price. Is that something that's happening now?
Oh, we implemented that 2 years ago.
Really?
So the QR code takes you directly to the vehicle display page on the internet for that particular car with the price. And the answer, the reason why we have to do that is, can you imagine the chaos if we had an algorithm repricing 70 to 75% of our used cars every day? Yeah. I mean, I'd have an army of people changing price boards. And let's be brutally honest, 50% of the prices on the forecourt wouldn't equate to what it was on the web.
Been there, done it.
I mean, we all know. So that is why QR codes are absolutely required. Now, in fairness, and this is a trading standards thing, if you actually walk towards the dealership, certainly in our business, you will find a price list in the window of every car, actually. So you don't have to use the QR code if you don't want to.
Well, Philip and I had this debate on the podcast about it, and it was all concluded that it's great for retailers because you've got that flexibility, as you say, with price changes, but not a great experience for the retailer. For the customer who's wandering around and just trying to benchmark cars because they've got to scan every single barcode.
Yeah, I don't actually think they do that anymore.
No,
really. I think most people do a lot of their research on the internet.
Yeah.
Oh,
they
right.
come in, they know broadly what's what. They've probably got a target car in mind. And then once they engage with the sales executive, we can then sort of introduce concept of other price cars. I understand your point, and it's just not practical.
It's probably a minority
changing 75%. I mean, let's be honest. We have price boards when we used to change the car prices once a month.
Yes.
Well, as a tyre kicking experience, it wasn't great, but I can see that it does work.
Yeah, but to be honest with you, you'd just be wasting everybody's time, Curtis.
Yeah, exactly. Now, Robert, we couldn't have you on without asking you about the introduction of the £40,000 expensive car supplement, which was introduced on EVs in April. Now, this is clearly something outside of the control of retailers. So how are you mitigating it?
There is nothing we can do to mitigate that. The manufacturers have mitigated it, because I was with one manufacturer yesterday and their entire range is now all priced below 40 grand.
Really?
So I think the manufacturers are doing quite a lot of work to mitigate it. It clearly was an absolute nonsense. I mean, who could have a regime of fining manufacturers if you don't sell electric vehicles, and then increasing VED and other charges on sale of electric vehicles. I mean, you've got to be particularly stupid, I think, to come up with such a thing. And even the government seem to have a bit of a realisation of this, because there is now a review going on of lifting the limit or getting rid of it altogether, and that's much to be welcomed. But the biggest impediment to economic growth and entrepreneurship and running a business is not the market, it is not Arnold Clark, it is the government. They are the biggest block to progress, and it's getting progressively worse. And this is a classic example. I mean, we had a letter I asked all my general managers to write a letter to their local MP about a month ago, outlining the problems with the ZEV mandate. And actually, I think 90% of them did write the letter, and I've got lots and lots of replies. And we had a reply from the brilliantly named Minister for the Future of Roads, which is, I mean, I don't know why they're going to need roads if they keep with their anti-motorist policies, to be honest. It's an interesting concept. But she wrote a letter, and I did confirm actually in this letter that the electric vehicle expensive car regime was definitively up for review, which is to be welcome. But I'm fed up of welcoming, backtracks from complete idiocy. These things shouldn't have been in place in the first place.
So she did confirm it's being reviewed. So at some stage we will see that 40,000
we will
raised, presumably.
We will. And I think what the industry is actually asking for now is just a more wider wholesale review of the entire electric vehicle strategy, encompassing incentives, infrastructure, taxation, because it is a big mess, isn't it? Let's be honest.
You do feel like they need to just get a clean slate, don't you, and review it all, because the flip-flopping U-turns, the changes. It makes investment and strategy planning very difficult, but two, it's just hitting financials continuously. It does feel that the ZEV mandate, the tweaks to it, welcomed, but let's be honest, not changing, are they?
The government's running out of money at a rapid pace of knots, and Vertu Motors PLC, because of the ZEV mandate, will be paying less corporation tax.
It's counterintuitive of what they are trying to achieve. But we won't get your view on the long-term stability of the UK government and where they'll probably could end up. But I mean, finally, Robert, I mean, we're just now about to enter June. Your financials up until the end of February. What's your gut feeling of how this year is going to pan out? I mean, there's a lot that is going on in the global market, about politics and the economy, etc. But fundamentally, we always come back to the control the controllables, stick to the basics. There's certain things you can control and certain things that you can't. What's your view on how the year is going so far, your gut feeling, and how you think the year will?
Well, I think Q1 was good because March was excellent. Market was up 14% in new retail. There is a little bit more life in new retail compared to last year, and let's hope that continues. Used car values are solid, so that's helpful. I think there's quite a lot of unknowns in for the next 9 months. The first is the impact of Trump tariffs and whether we get more new car volume being pumped into the UK as they divert supply, which would be quite damaging to margins. Second is an unknown about what the changes to the ZEV mandate will mean. Will we get into the same rationing and discounting and a very low new car market, particularly in the second half? And I don't honestly know the answer to that question. But I think the ZEV mandate remains a pretty big problem. And then the third is, where is the UK consumer?
Yeah.
And I don't think they're in that robust health, actually. And I think they could be quite volatile. We've got a lot of political changes. We've got real pressure on the Chancellor. We're going to see very negative headlines about the UK's ability to raise debt, about the squeeze on growth, about the whole economic situation. And that could have quite a negative impact. So I think there are some positives in the sector. Hopefully the Finance Commission issues will get resolved within the next 6 months. We've got residual values fairly good, I think, in used cars, but there's quite a lot of uncertainty. So I think we're being quite cautious, actually, in terms of our outlook. Yeah,
it feels that it's kind of more of the same, isn't it? You need some clarities in a few areas. The ZEV mandate and what the OEMs will do, particularly in the second half of the year, as you alluded to, that's where the real pressure comes as they sort of start to realise their position in Q3, Q4, which is when the pressure kind of comes on. Yes. And as you say, the discretionary commission is still lingering on in the background with no real clarity of what the outcome will be. And they've got the High Court, but actually it's the DCA that will be the fundamental shift that could impact the sector.
Yeah, and I mean, let's be honest, I think within 6 months that'll all be sorted out.
Yeah. I mean, again, Robert, we could sit and chat for hours on these kind of things. There's so much going on, but it's great, as always, to have you on the podcast just to give a little bit of sort of context to the financials and get your view on the market, which is always welcomed and respected. So thanks for taking the time today. It's appreciated, and I hope the weather clears up a little bit for the weekend, but appreciate.
Oh, we don't want it to clear up too much.
No, you don't want it too nice. You want
like this drizzle.
You want the customers in. You want the customers sat indoors looking at cars on your website, don't you? That's what you want. Yeah. But no, appreciate that. Appreciate your time, and have a fantastic weekend, Robert, as always.
Thank you.
Thanks for coming on, Robert.
Well, as always, Robert, on good form, good catch up there. Managed to get a lot into those sort of 20, 25 minutes with Robert, don't we?
Yeah, definitely.
Of everything going on in the world of politics, economy, automotive, you name it.
Yeah, because we were ostensibly just going to be talking about his financials for the year, but there's a lot going on at the moment, so we couldn't resist the temptation to ask him about some of those developments. And as ever, he's very sort of forthright and transparent about his views. Yeah.
So hope you enjoyed that extended chat there with Robert. We may share it in the coming weeks as a standalone listen, but there is a lot coming up on the Motor Trade Radio podcast. So hopefully we've managed to get a lot into today. A little less listening to me and Curtis go on too much about the headlines, but maybe next week it'll be resumed to normality. But we'll see. You never know what will come our way. But hopefully you enjoyed today's podcast.
But that's all for now, so many thanks for joining us on the Motor Trade Radio podcast. Until next week's supplier special with ETT, the supplier of AI call handling tech to car dealers, it's goodbye from me.
And it's goodbye from him.
Thank you for listening to the Motor Trade Radio podcast, powered by Motors, the driving force behind multi-site advertising. We'll be sharing all the URLs from this week's headlines on Monday morning. To make sure you receive them, just subscribe to the free newsletter on our LinkedIn page. Just search Motor Trade Radio Podcast.